The week has started and it's not looking very good at all. We see many companies continuing that downtrend, including the Mag 7, and in fact we can see the continuation of AI giant Nvidia down nearly 4%. Now when we zoom out to over just the last 30 days, pretty much every single company in the Mag 7 is down double digit, other than Microsoft down 7%, but we also see this spread across to other areas. For example, we notice even Costco, which has been on an incredible run, down nearly 12%. And when we look at the year to date, we are purely talking just the first 3 months of the year. Again, there is a widespread downward trend for the Mag 7, whereas other companies we have noted are starting to perform fairly well, so you could perhaps see this as sector rotation. Yet Berkshire Hathaway is up around 16%, and as we'll show you, the S&P in fact is down around 6%. What's even more fascinating, as we highlighted yesterday, is that their cash pile is at record highs, sitting at just under 350 billion, so it does look like Warren Buffett continues to be one of the best investors to watch closely. And as we can in fact see, year to date, one of the worst performing, Tesla, down 38%. In fact, they've lost nearly half of their total market cap we are talking about in just the last 30 days. Likewise, we have Nvidia down nearly 22%. We're talking in the first quarter of the year, losing nearly 1/4 of their total market cap. Now, what makes this very interesting to note, because on a historical basis, over the last 100 years, we can in fact see that March has tended to be a fairly strong up around 0.57% on average, and not the poor month that we are ending today, and April has historically been the second best performing month, so let's hope for investors that it does turn out to be the same in 2025. Now, I'm sure no one is surprised, given the recent and ongoing events, that investor sentiment is back into the extreme fear, talking around 19 points, but this is something we have now seen over the last 2 months, and with the information we're about to run through, the global trade war that does look to be on the cards, the geopolitical tensions, we could perhaps be here a little bit longer than we do ideally want. Now remember, there are many articles that will come out talking about a massive drawdown, but one that we have referenced to before is Bank of America, where last month they said the S&P could be down in 2025 at least 40%, and they're referencing the .com and Nifty 50 era, where they believe we are seeing a lot of overvaluation, and as the markets do come down, perhaps this is just, in their opinion, getting to reasonable territory, as equities are priced for perfection. Now, we're only days away from what Donald Trump has referred to as Liberation Day. This is where a lot of tariffs are going to be coming into place. We're going to understand a little bit more about the severity of them for the countries that will have these imposed, and we also notice that also from his own supporters, they are starting to get a little bit worried about how these levies are going to affect the US economy. But one thing is for certain, at least in his second term, he will not make any decisions based on if the S&P or the Nasdaq is going up or down. He's sticking very firm with tariffs, which, as we've highlighted before, in his own eyes will make the United States a lot stronger. Now bear in mind, this month we did get a correction which is effectively 10% or more, and this is something historically that is noted at least once every year. A severe correction 15% or more once every 2 years, and a bear market, which we're not that far off, in fact 20% or more, is noted once every 3 years. This is just to highlight that what we're seeing isn't a once in a lifetime event. We get these every single time in a market cycle, and actually could be a good opportunity to consider adding high quality companies to your portfolio, something we will get onto shortly. Now we can highlight the S&P is down just over 1% today, and year to date, again just in 3 months, it's down more than 6%. We're talking around 5,500 points, and just on Friday we saw over $1 trillion wiped from the market, something that probably we will get at least today if this downward trend does continue. We can also flag that the S&P, since Donald Trump was in place in his second term, is down around 10%, yet when we look at his first term, it was a lot stronger, at least in that initial year, where in fact, as we will come to show you, he did perform fairly well over the course of the years. Now remember, at the beginning of the year, we do get analysts who, as we would always say, don't pay too much attention to, but they give their forecast as to where they see the S&P. Now remember, we've just highlighted that it does currently sit at around 5,500, and we pretty much had a lot of analysts referencing the S&P to hit over 6,000. In fact, we had some sitting at 7,000 points, and you're probably not surprised to see that some of them have started to cut their targets, and in particular we want to reference Goldman Sachs. Their initial target for 2025, as we can see here, was 6,500 points. They then went on to cut it to 6,200 just a few weeks ago, and now today they've cut it again. They've put this at 5,700, and this is why we ultimately say don't read into too much what analysts expect for whether the S&P or other companies, because they will start to cut them if things do deteriorate, and likewise if things get stronger they will revise them upwards. Now, interesting to note for Goldman Sachs, they effectively put this down to slowing growth as well as rising uncertainty, something that the markets don't like to see, as in fact we can note from the drop, and they believe this warrants a higher equity risk premium and a lower valuation multiples for many equities, and again that is something that we can in fact see. Not only that, Goldman Sachs have actually got one of the lowest earnings per share forecasts for 2025 and 2026. Strategics and analysts estimate 9% this year. They've actually said only 3%, with next year sitting lower than both the 9 and 14 of analysts at the 6% point. Now this is all well and good, but do remember Goldman Sachs, like other analysts, don't have a crystal ball, and they will continue to change their forecast depending on how the market reacts. And as we alluded to earlier, Trump in his first year when he was president in term 1, we did see a return near the 20% mark. Now obviously this year has really just begun. We are only a few months into his presidency, but again these are just some signs, and the market, as we highlighted, does not like uncertainty at all, which is exactly what these tariffs are doing. Now I'm sure everyone by now knows Tom Lee. He appears on CNBC, a very popular analyst, fairly bullish as well, and he's been saying for the last few weeks that we are due a face-ripping stock market rally, and he continues to come onto CNBC and say that the sell-off that we are noting is such a massive overreaction, and that effectively the markets are so oversold and pessimistic a sizable rally is near, and he's gone as far as to say the odds of a 10 best day coming are very, very high. And we just want to remind you what this effectively means when looking at historical data. But the Great Recession 07-09, where the S&P declined 55%, we in fact got the best day in the market October 13th, 2008, where the S&P was up 12%. Again, we noticed the second best day during that period up 11%, and in fact you can see during the Great Recession a few more points where in fact the S&P did climb quite significantly, and that is one thing that Tom Lee is essentially insinuating. We are going to get one of the 10 best days in the market very soon. He also believes the S&P is going to be driven higher by Tesla, which he effectively says it is due to be around the $488 over the next few months. But in fact, we can show you it's down a massive 7% today, trading at $245. Whether or not this does hold true, as we can see, we are quite a large way away from the $488 price. He also had estimations that the S&P would hit 7,000 points in the middle of the year, dropping down to around 6,600. But as we just noted, we're sitting at 5,500. We are pretty much around 10% away from that point. Remember though, as we always say, to do your own due diligence and never really rely on what they say, because just in the first 2 months of Donald Trump's presidency, we have seen the S&P drop by around 10%, and it continues to go lower, with trillions being wiped off the stock market every single day. However, one positive spin on this, there's only been one president, in fact George Bush Jr., where the S&P during the whole term of their presidency did in fact decline, and we can see, unfortunately for him, it was for both of his terms. Yet with other presidents, and including Trump in 2017, over the whole 4-year period, positive returns were established. Now, if you're someone in the camp who does actually believe a recession is around the corner, well, what this ultimately means is that the S&P typically during this time drops around 25%. For those that want to just look at the past few periods, in fact, we got the COVID drop where it was over 30%, the Great Recession, as we mentioned earlier, sitting around the 55%. So it is very difficult to establish, one, if we are heading to a recession and the implications, but just on historical data, it does sit around the 25% point. But again, no one knows if we are going into a recession. And interesting to note, when we look at the forward P of the S&P, depending on what camp you sit in, for example, if you do believe a recession is near and that the S&P in terms of the forward valuation would be at 20x moving forwards, then it is talking about a drop around 21%. But again, these are all just purely different scenarios. The only thing we would, however, say is that at the moment, the S&P is trading at a ratio of 27.8. And if you're someone that does like to look at historical data, well, in fact, the mean and the median does sit around the 15 to 16 point, so it could also be overvalued when looking at historical data. A few other things to point out is what we've also noticed in terms of flows, or inflows we should say, to the market. We are noticing it become lower and lower over the last few weeks. Whether or not you believe this has any indication of how the market performed, just one point here to note that retail investors are in fact starting to worry a bit with the drops we have seen, with how these tariffs will affect the wider economy and whether or not this will be long lasting and ultimately see the S&P dragged lower and lower. Now look, this tariff talk isn't something that is new. When we do look at 2018, the same thing was to be noted, and we did in fact get a drop. However, it did rebound quite significantly all the way to 2020 COVID, and then we did get that infamous drop. But the point to understand here is this isn't the first time that Donald Trump has been referencing tariffs, and this is also something that Tom Lee in his latest article, March 28th, does talk about. He says that stocks have been rallying for 2 weeks, and while strength may be difficult for many investors to reconcile and the prevailing skepticism, they believe that equities did bottom March the 13th following a 10% drawdown. Now, he says many market participants do remain cautious ahead of April the 2nd, which does mark the tariff liberation day, yet we view the current market action as a repeat of the setup from 2018 during the first wave of the tariff under Trump's administrations. And they also point here 2018, as we highlighted, after a sharp 12% drop, which was triggered by President Trump's comments on tariffs, the market did bottom. Whether or not you want to look back at history, as they say, history doesn't repeat itself, but it does typically rhyme. And the other thing we can point to here is that the S&P, when we do look at the current ratio, it does lie in one of the highest over the longer term. In fact, over the last 30 years, it does sit in the 82nd percentile. Again, just facts and statistics for those that like to incorporate it into their own investment thesis. And we would also like to point out, if you're someone that likes to look at the market on a forward valuation basis, we are starting to see value across there, but also companies that trade very high, even with the drop. For example, Apple, 27 is still wouldn't be one that we would consider, given the lack of growth opportunities we see, at least in the shorter term. You've got Google now sitting around 15, Meta around 19, even Nvidia around 18, a lot of potential opportunities. Again, we will cover this, but our main point here is to really illustrate that even with the drop we're seeing, there are some companies that still could go even further and we still would believe to be overvalued. Now we're going to run through 5 stocks very quickly, high level, just to show you how significantly undervalued they are. The first one, Nvidia, that continues to drop, down 5% today. Over the last year, it is up 15%, but year to date, now down 22%. As we said, nearly 1/4 of their market cap lost in 2025. Over the last 10 years, nonetheless, they still have massively outperformed the S&P, up 18,000%, trading now in the mid to lower end of the 52-week range, a strong buy rating from Wall Street, a buy from Seek Alpha, and a forward P, as we will come to show you, 24. That is very low, as in fact we can show you significantly below their 5-year average of 42.9. Therefore, we would call this a severe undervaluation signal, and something that is reconfirmed when we look at the blue tunnel here. One, this is the expected fair price. Second thing to note, it is increasing over the longer term, something we always want to see from companies we're considering or companies we're investing in. But what we really want to drag the point home here is it is massive disparity from where this company sits and even the lower end of the blue tunnel. Again, another severe undervaluation signal. Now, when we've done our intrinsic value, it has come to $162 derived from the DCF model. You can see the free cash flow year on year, including the latest year. We've gone for a growth rate of 20% moving forwards. Bear in mind, over the last 5 years on average, 153%. Over the last 10 years, 104%. But with the 20% and the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, 162, which does indicate 55% upside. Now remember, our low, medium and high, 15, 20, 25 are all subjective. You can grab a copy of this model by clicking on the pinned comment below, but even at a 15%, if you do believe that that is the growth rate over the longer term, it does give an intrinsic price of 115, still indicating upside of 10%. And for those that are a lot more bullish, at 25%, 227, indicating 116% upside. That is more than a double from the current value. Now, typically on the channel, we take the median rate of 20%. We're not done there because we add an MOS, margin of safety, 10%, execute on that if it meets our 3 golden criteria. wide moat, strong financial metrics, good forward-looking data. Now look, if you believe that in today's episode, a buy at $146, then we keep going till it's near the current trading price. And what we're effectively saying today, you're getting a massive 35% MOS with Wall Street, strong buy rating, super bullish. They see this at 177 over the next year. That is a 69% upside. As always though, do give us your thoughts on these stocks. And if we just go back and show you that even at the low rate of 15%, you are still getting a small margin of safety. You're in fact pretty much getting 10% now if you believe they can grow their free cash flows at 15%. And just as a reminder, look at the last 5 years, 153%, over the last 10 years, 104%, just in the most recent year, 125. So if you want to be incredibly conservative, you're still getting a 10% MOS, and Wall Street, whilst we would say do your own due diligence, don't rely on them, they estimate 69% upside just over the next year. Now before we move on to the next stock, we just want to let you know we have released our latest free weekly article. We drop on every single Monday morning to your inbox completely for free, where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up, read straight away, where you'll also be able to gain access to severely undervalued stocks for this month, lots of information for each one, upside that Wall Street themselves see over the next year, and we will also be releasing a copy of April in the next few days. You'll also be able to grab a copy of 97 stocks that Wall Street themselves believe have the most upside in the S&P right now, so click below, you can sign up and read straight away. And included in this Monday's article completely for free is a spreadsheet running through all the dividend kings, taking a look at a lot of information, including the upside we note, in fact also those that we believe to be overvalued. As we said, click below, sign up and read straight away. Moving to the next one, we have Novo Nordisk, the big pharma company, down 50% or thereabouts just over the last 12 months. Year to date, down 20%. Over the last 10 years, still marginally outperforming the S&P, up 148%. Now trading at its 52-week low, we have a double buy from Seeking Alpha and Wall Street, a fairly attractive yield at 2.3%, and a forward P sitting around the 17-18 mark. Now, if we're to show you that against their 5-year, not only significantly lower than 30.4, but also the cheapest it has been trading for over the last 5 years, a completely severe undervaluation signal. Included with that, the yield at 2.41, well above the average of 1.41, and the highest it's offered over the last 5 years. Again, another severe undervaluation signal. And we can also show you the blue tunnel here, in fact, trading massively below, a lot of disparity between even the bottom end. Again, severe undervaluation signals right across the board. If we were to show you our intrinsic value, then it comes to $101, and you can see the growth rate we've gone forward is 14%. That gives it 101, indicating 51% upside. As we do come to show you the margin of safety, it is quite substantial now. You are getting at least 30%, up to $71, and in fact near 35%. Wall Street themselves incredibly bullish, 112 over the next year, 67% upside. But look, we'll also show you, for those that believe that is way too high, you are still getting an MOS. In fact, at 20%, a buy at $70, at 25, there or thereabouts. So if you believe the lower rate, 25% MOS. If you believe the higher rate, 35%. Nonetheless, Wall Street's price target untouched, a massive 67% just over the next year. We then move on to the semiconductor giant ASML, down 3% today, down 33% over the last year, losing 1/3 of their market cap. Year to date, down around 6%. Over the last 10 years, still outperforming the S&P, up 556%. They do trade at their 52-week low, a double buy from Seeking Alpha and Wall Street, and a forward P sitting around the 26 mark. So if we take a look, that is significantly lower than their 5-year average of 34, whilst also a yield above their 5-year, two undervaluation signals. And we can also highlight the disparity between where the company sits and the expected fair value. Again, another severe undervaluation signal. As we look at the price, we get to $1,055. Now, we have gone for a growth rate of 14% moving forwards, which does indicate 60%. But again, MOS here will be very significant as we do in fact keep on going. You are getting not 40% just yet, but at least 35%, up to $686. With Wall Street, $940 over the next year, upside of 42%. And we do also want to reflect the lower rate today at 12%, where upside is at 39%. Don't forget again, you can grab a copy of this model by clicking on the pinned comment below, run your own numbers through whether it's ASML or any others, and we can keep showing you are getting a margin of safety even at the lower end, 25% up to 690, and at 30% not quite there yet, so 25 to 30, as we said, Wall Street 940 over the next year, 42% upside. We can't do an episode like this and not talk about Alphabet. It's pretty much flat over the last year. Year to date, down 20%, losing 1/5 of their market cap. Still outperformed the S&P, up 453%, trading pretty much at its 52-week low or thereabouts. A double buy from Seeking Alpha on Wall Street, a forward P now sitting at the 17 mark, and as in fact we can see, significantly lower than their 5-year average of 22, and in fact the lowest it has been over the last 5 years. And no surprises here, there is disparity between where the company sits and the bottom end, and when in fact we get our intrinsic value, it does come to $226, using a growth rate of 12%, upside of 49, and we will show you there will be quite a significant MOS today, given the drop we do continue to see from this company. In fact, you're getting not 35% just yet, but at least 30. Wall Street's price target, 220. 45% upside, and we'll show you at the 10% growth rate here, you are still getting a margin of safety. 10% a buy at 177, at 20 a buy at 158, and at 25 not quite there yet, so at least 20% on the low growth rate with 45% upside, and do give us your thoughts below. And lastly, we get to Amazon. In fact, a double strong buy from Wall Street and Quant, a buy from Seeking Alpha, trading in the mid to lower end of the 52-week range, a forward P sitting around the 30 mark. Over the last year, up 3%. Year to date, down 15%. Over the last 10 years, though, massive outperformance, up 870%. And our intrinsic value of $230, when we do in fact get to the DCF model, we've used the lower rate of 20%. That is 24% upside. If you believe 25 perhaps to be more appropriate, 75, and 30, 144, more than a double. So taking through the lower rate in fact today for Amazon, at a 10% MOS, a buy at 207, at 20%, pretty much where we see this company now, a very high quality one in the Mag 7, 20% MOS, Wall Street themselves 270, that is upside of 45%, and as we said, do give us your thoughts below. Don't forget, as always, sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon where we do cover our weekly buys and sells. Come and join us in fact as a member on the channel, and as always, have a great day. We'll see you all on the next one.